Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
And today we have one big, beautiful life insurance podcast to talk about.
Yeah, we do. And we're not even really going to talk about life insurance all that much.
I mean, it'll come up.
It's tangential.
It plays a pivotal central role here.
Yeah, that's true. That's true. I may have overstated the case.
Yeah, that's no big deal. The zoomed out look on this will be not much about life insurance, but if you know, you know. And
I'll have to admit, when I was looking at the notes, I was like, the OBBBA,
that's a fun one, right?
I mean, our government loves acronyms. That one's not even catchy. Like, how many, if you said it out loud, you know, the OBA.
Yeah.
Or WABA. Or ABBA. Like, how many B's does it have? Well, more than you would think. Anyway, here we go.
Yes. So, prior to the adoption passage of the One Big Beautiful Bill,
which passed last year, right?
Yes. There was.
It seems like 10 years ago. The last year seems like 10 years for some reason.
It's been a long year. Yes.
Yeah.
It just has. There was a lot of hand wringing about the federal estate tax exemption.
Right.
Now, why?
As it has been multiple times.
Well, there. Okay. Yep. We have been through this a time or 10.
It feels like it.
And
I've been in the business for 26 years, and I know we've talked about this at least, not you and I just mean as an industry as a whole, this has become a hair on fire thing at least 3 times, maybe 4, maybe more.
Mm-hmm. We're being a little cryptic. Let's let the uninitiated in on the secret. So the estate tax exemption has long been a political lightning rod.
Yes.
And there have been efforts to win political points by shifting the goalpost on when you are and are not subject to the tax.
Yes.
But
sort of depends on the political wind of the moment. You know, do we hate rich people, or do we like rich people? Right.
Except there's a spotted tree owl here that grows a lot of corn.
Yeah.
So there's been this constant effort to just kind of nudge things along by increasing the exemption and making fewer and fewer people subject to the federal estate tax.
Right.
But nobody, for whatever reason, ever wants to make that moving of the goalpost permanent.
Right.
So every couple of years, we're running into the end of the special provision of the estate tax exemption.
Right.
The sunsetting of that former change. And everybody runs around saying, uh-oh, this might go back to where it was. And if it does, it's going to make more people have to pay the federal estate tax.
Right.
How many more? Well, not that many, but more nonetheless. And so the insurance industry, which at one time got really fat and happy on the federal estate tax.
It was a big deal when I started 20 years ago. Yeah.
For reasons
the exemption was like, I always have to speculate. I think it was
around
675,000, 650, something like that. Yeah. Which ensnared a lot of people, by the way. In fairness.
It did. At that time, there were a lot of people who, the wrong way to put it, but accidentally ended up with an estate tax problem.
Right.
Because we had a massive appreciation in certain assets that middle-class people had.
Yeah.
That the estate tax was not intended to tax, per se.
Right.
So, big run-up in the stock market.
Farmers used to be a big deal.
They were a big deal, and we're going to talk about that today.
Okay.
So, big run-up in the stock market, big run-up in real estate pricing, which caused a number of people to be in receipt of assets that totaled more than $650,000.
Right.
Which meant they had to file for the federal estate tax upon dying, and their estate potentially owed this tax.
Right.
So that became a little bit of a problem. And the life insurance industry had a very, very good solution to that problem. You simply set up what we call an irrevocable life insurance trust. You gift money to that trust. The trustee buys life insurance with it. And following that process and a few other technical things that must be done in order to make it work under the tax code, that life insurance policy is no longer part of your estate, which means your heirs can use the proceeds of that life insurance policy to pay the federal estate tax upon your passing.
Right.
Worked then, works today. Nothing wrong with that strategy.
No.
But the efforts to move the parameters around in terms of who is and who is not going to be subject to the federal estate tax, those have changed, and they've changed in a big, big way.
Mm-hmm.
And that puts us in a position where now people, or the life insurance industry, does not have near as many prospects as it once did.
Right.
To talk about ILITs, irrevocable life insurance trust.
Right. Let's go back. I mean, I just want to clarify, because you and I are familiar with this. We've been talking about this stuff forever, but people are listening and like, what is this even about? The big deal going back 20 plus years was you could have someone die who had 600, let's just call it 650,000. It's scaled up, so please don't, do your own research.
It's not that number anymore.
No, but it was 650,000. Well, you could have someone die who had a small business or a small farm. And the IRS values their taxable estate at $1 million.
Yeah.
And this person literally has $50,000 in the bank.
Yep.
I mean, it's just very common amongst that category of people. They're on paper, they're asset rich, but they're cash poor. And so what the life insurance in the irrevocable life insurance trust, or irrevocable, depending on how you want to say it, did was provide liquidity to pay the estate tax, so that the family in general didn't have to sell the assets to pay the tax.
Correct.
That was I don't know if I nutshelled that well enough, but
yeah,
that was the issue, the concern.
I think so. It was all about creating liquidity, because for a number of people, the assets that they held that created their estate and made it taxable were not assets that were always easily liquidated.
Almost entirely, yes.
So if you own real estate, if you own a business, if you own a farm, the logic was those are not things that you can easily or even partially liquidate.
Right.
And you got to have the money come from somewhere.
Oh, what if you have a farm and your kids work on the farm and they need the income from the farm to survive, but now you have to sell the farm to pay the tax? I mean, you can go down that rabbit hole.
Yep. And by the way, the tax is due 9 months after you die.
Yeah.
So there's not a lot of time.
Right.
So that is the dilemma. And all of what we've talked about is a lot of the framing that has been used by life insurance agents, financial advisors, and attorneys to paint the picture for people and make them understand the circumstances, and also push them in the direction of saying, hey, maybe this is going to be a problem for me and I need to take care of it. So I need to have the trust drawn up. I need to buy the life insurance policy. That's
right.
That's the process. Now, the sensationalism that has always caused a little bit of an eye roll over here is the overstating of how many people actually have to worry about this.
Right.
And there's kind of a two parts to this. I mean, one is the life insurance industry trying to sell life insurance policies. Okay, we get that. The other one is the politics of the estate tax, which has been known as the death tax among people who wanted to campaign against it. And again, the farm situation was their favorite example, because farming is a business where you may become very asset rich. Farmers wouldn't agree, but they own a lot of land and equipment and things like that. All of that has value. And so when we total up the value of those things, at death, they may end up in a situation where they owe the federal estate tax. These are not people who have tons of cash on hand. Your point was very good earlier where you mentioned they may total up to something like $1 million, but they don't even have $50,000 in the bank.
Yeah.
And that is a conceivably real circumstance.
Yep.
And so farming was something that the insurance industry looked for because they were potentially people with a bigger likelihood of falling into the estate tax trap. But it was also a great example that politicians used as the unintended kind of collateral damage of the estate tax because these people shouldn't really be paying this thing.
Right.
Now, the issue...
They're balance sheet rich and income statement poor.
Right.
I mean,
now,
that's very common among that sort of small business, small farm.
Yeah. Now, in truth, the number of people today who are at risk of owing the federal estate tax, who own a farm, is small. And the other truth is it always was.
Yeah.
So
what were the statistics? You had some.
Yes, we do have them. And the number of farms that were expected to be subject to the federal estate tax if the one big beautiful bill did not create the permanent exemption that it did was roughly 1% of all farm operators.
Right.
So that would have meant that it got cut in half. It's currently $15 million per person indexed for inflation. So it will go up.
Yeah.
But
if it would reverted, it would have gone back to 5, right?
7.
7.
5.
Sorry.
5 was the basis. 7 is where it would end up with the inflation adjustment.
Yep.
So at that point, roughly 1% of all farms would be subject to this. At 15 million, we can infer it's far, far fewer than that. But even going back to a day when the estate tax was $650,000, the number of farms that were subject, or the number of farms that were likely to have an estate tax problem, was still a small number.
Yeah.
At that time, so we're talking the late 90s, a $650,000 estate tax exemption was definitely more likely to hit a number of people, and farmers were on that list. But, if we look at just average cost of an acre of land, farmland, and we look at the average size of a small family farm, the majority of them didn't come anywhere close to the federal estate tax even back then.
Right.
And the growth of the federal estate tax from that time to now has significantly outpaced the growth of family farms in the United States.
Yep.
To quantify it for you, the estate tax exemption from 1999 to present day is 23 times what it was back then. Mm-hmm. So 2025 numbers, or actually 2026, because we know what it is already, relative to 1999, it's 23 times larger than that. Farmland has grown in value or a little more than 4 times what it was in 1999.
Right.
Now, understand, not everything valued at the farm is just land. There are other things. So, okay, yes, there are some adjustments that we need to make. But there's a good gap between 4 and 23.
Yeah. A little wiggle room.
Yep. So, in fact, the annual growth rate, compound annual growth rate of the federal estate tax exemption from 1999 through 2026 is 12.83% per year. Most Americans are not holding assets that grow at that rate.
Right.
Consistently.
That's true.
Unless you're Dave Ramsey.
I wasn't going to say it. You said it.
It just doesn't happen. So the idea that you're going to suddenly just go bonkers growth on your stock portfolio and suddenly become estate taxable, that is highly, highly unlikely.
Right.
Because the growth of the estate tax exemption has vastly outpaced even U.S. stocks.
Yeah. Mm-hmm.
And we've had this conversation with people. There are definitely people who we have met who have estates that are valued close to the exemption.
Sure.
And they're worried about what that might mean from the estate tax point of view. And first, we have to remind them that, well, it is indexed for inflation. So it's going to grow as well as your assets. And it may outpace the growth of your assets. And there's been a lot of political jockeying to cause it to grow faster than your assets. But then the other thing you have to keep in mind is the life insurance play, or even the trust planning aspect of it, is not unimportant, but it becomes significantly more important the less liquid your estate is. So for example, if under current circumstances, you have a $20 million estate that is completely comprised of stocks, bonds, and cash.
Right.
You could buy life insurance to pay for the estate tax. You could do that. But you could also just liquidate some of that position and pay the estate tax.
Yeah.
Which is the most heretical thing I can possibly say as a life insurance agent. I understand that.
I think it's just a cost-benefit analysis you have to do, because it's not as if the life insurance and the setting up and administration of the trust is free of charge. So
Correct. And we're going to touch on this in a few minutes, the decision to do this, set up an ILIT and gift money to the ILIT to buy life insurance, is an irrevocable, that didn't work out well.
Now you got a
irrevocable decision.
Yeah, that's what, it's in the name. I don't know what commercial that was. It's in the name.
So let's just very quickly, one big beautiful bill permanently established the exemption at the basis of 15 million. It's going to grow for inflation from there.
Yeah.
And it did it permanently. So there is no sunset to this anymore.
Right.
We are theoretically not going to revisit this in a few years. There's always the chance that Congress could decide we're going to bring it back down. But at this point, there won't be...
It's just no automatic.
There won't be hair on fire about the fact that this is going to expire.
Right.
Even though, again, we went through this numerous times over several decades, and every time we were told it's going to expire, it never did.
Right.
So, the planning aspect here is not being superficial about the real implications and mechanics of the federal estate tax. Because the other thing that we forget to talk about is $15 million is the exemption. Which means if you have a $15 million estate, you do not owe federal estate taxes.
Right.
And the $15 million is per person. And as a couple, you can actually combine your exemptions. A married couple, I should be clear about that. So you actually get like a $30 million exemption at that point.
Yep.
You have to have assets in excess of the exemption in order to owe a federal estate tax.
Right.
And the federal estate tax is a progressive tax. So it grades up. It starts at 18%. It caps out at 40%.
And it's only on the amount above.
Correct. It's not retroactive back to $1. So what that realistically looks like is, in order for you to have like $100,000 tax liability under the federal estate tax, you have to have assets that are in excess of something like $250,000 to $500,000 of the federal estate tax exemption.
Yeah, right.
Before you actually have a $100,000 liability under the federal estate tax.
Right.
So,
and the math has to work in your favor still.
Yeah, well, the decision
the costs we're going to talk about.
Yeah, the decision on what you do. And so, to your point, you have to pay to have an ILIT established.
Yep.
That is a fairly advanced form of trust drafting. That's not something you should leave to the powers at LegalZoom.
I wouldn't.
I don't even know if they will do it. I don't even know if LegalZoom is still doing things. But anyway, that is something that you would go to an estate planning attorney for. And there are provisions to ILITs that differ from situation to situation, sometimes even state to state.
Right.
And they're not cheap.
Right.
This is not going to be an inexpensive trust Like if you have a living trust that you had drafted years ago, and you go to have an estate planning attorney, a good one, draft an ILIT, you're going to be kind of surprised at how much more expensive the ILIT is versus the living trust that you set up.
Mm-hmm.
Because they are very different animals. They serve very different purposes.
It's going to have a comma in the number.
Yeah, it is.
And there may be more than one digit to the left of the comma.
Yes. Yeah, it could very well be the case.
It just depends.
Yep.
But.
And then the other piece to this is you have to name a trustee. Because unlike your living trust, which you can be the trustee of and control, you are relinquishing control of the assets that you gift to this trust.
That's what makes it irrevocable.
And you can do what we have seen done numerous times, which is not always the best idea. You can randomly pluck a family member and tell them, hey, I need a trustee for my ILIT. Would you mind doing that for me? Mm-hmm. That's an option. But the safer option is to hire an actual trustee to oversee the trust.
Right.
Trust companies. Sometimes attorneys who draft them will also be trustees for you.
Sure.
Those are options, but the trustee has to get paid for their services.
Right.
So now it's not
there's
just
actually things they have to do. I mean, it's not.
Yep.
It's not just a title.
Correct. So now it's not just the one-time cost of drafting the trust. It's the ongoing expense of whomever is providing trustee services to you, assuming that you don't just go the route of, hey, my brother's going to do it.
Right.
So this is a real expense. And to your point, you got to look at your liability and decide, is going through all of the hassle and expense of the ILIT going to net out enough benefit to go down that road?
And it might.
Mm-hmm. It could.
We're not here to be down on ILITs.
We're not. There is absolutely a segment of the population, a very small one, but a segment of the population that should, without doubt, have an ILIT.
Right.
And use it for its intended purpose.
Yep.
But there's also been a number of people who have been sold the concept of an ILIT who didn't even have an estate tax liability to begin with.
Yeah.
And I can tell you from my own experience, I first ran into ILITs. First year in the business. There was an individual who lived kind of near our office who became the trustee of his son's ILITs, or son and daughter-in-law's ILITs, that were funded with term life insurance, and had several questions about what was going on. And so I obviously knew very, very little about all this, but had somebody who knew a lot about it. So could lean on that individual to usher between and actually get questions answered here. And learned a lot about ILITs very quickly. But here was a situation where the son and daughter-in-law who established these ILITs and gifted money to them to buy these life insurance policies did not have estate tax liabilities.
Right.
And the whole reason that they established them was because an agent that they worked with suggested to them that one day they might.
Right. So it's a lot to go through.
Uh-huh. It is. Now, the end of the story is those ILITs don't exist anymore.
Right.
Because it turns out they didn't then, and they kind of figured out after time that they were never going to. So that's the end of that.
Well, let's talk about, we don't have a lot of time left here, but what were some of the beats of the problems that were created last year in the run-up to this change in the One Beautiful Bill?
Yeah.
One big, beautiful bill. I forgot. You got to have the big in there.
It's very important.
Yeah.
So the pitch basically was, look, if this thing doesn't happen, we're going to go back to a much higher estate tax potential liability because of the reduction in the exemption.
Right.
So now you're going to find yourself in a place where you didn't owe the estate tax and now you do. And so it's higher right now. That sets you up to take advantage of two things. One, just establishing this ILIT while the exemption is still high.
Yeah.
And the strategical benefit here is you can use the gift tax, which has been unified to the federal estate tax exemption. So if you need to put more money into the ILIT initially than the gift exclusion will allow you to use, you can take advantage of this larger current exemption and gift tax to do that right now.
Right.
If we get the rollback, that's going to go away, but you can still use it because you did this while it was in effect.
Right.
So the problem, to get super deep in the weeds in an effort to do it in like 20 seconds, is when you establish an ILIT and figure out the amount of premium you're going to have to pay to fund the life insurance policy that the ILIT's going to purchase, sometimes that premium that's needed is larger than the gift tax exclusions.
Right.
I say exclusions because you can gift the gift tax amount per beneficiary per grantor. So husband and wife can gift $19,000 each per child if children are the beneficiaries, for example.
Per year.
Per year, yes. So that
Right.
can get you a relatively large premium size, but sometimes what you need to put in there is larger than that. So the other option is you have to use some of your gift tax credits,
Right.
at least initially, to get the requisite amount of money in here. And the idea is if it's going to revert to a lower number, do it now, because you won't be able to do it a year from now and still have that gift tax credit.
Which was all true, by the way.
Yes,
I mean,
none of that's untrue. The skeptical.
We're not trying to paint a picture of somebody doing something untoward here.
Yeah, the skeptical eye here, and this is not one of saying people are lying, it's more about calling out incompetence, is how likely is the reversion to take place?
Right. Which
Because
is hard
again,
to know. I mean,
again, we've been here before.
Yeah.
And every time, the reversion never happens.
Right.
So that's...
And to me, it's one of those things where it's like, if there was a clear-cut case, then yeah, it was worth it, right? It's the edge cases that are...
Right. To the individual who's got an $80 million estate.
Yeah, it's a no-brainer.
And it's all wrapped up in a business that they started.
Sure.
That makes a lot more... That puts a lot more oomph behind the ILIT discussion.
Sure.
There is no doubt about that.
Right.
There are potentially some other options that are on the table that can be entertained. Depends on their circumstances.
And there probably are at that level. Most of the time. There's a lot of things on the table.
Well, that's kind of the piece that made ILITs such a kind of middle-class-ish focused discussion for the insurance industry back when we had a much, much lower exemption.
Right.
So if you're extremely wealthy, you typically have lots of banking relationships.
Yeah.
And there are specific loans that the banking industry makes available to estates when there is an estate tax liability.
Right.
So the heirs can borrow money to pay the estate tax. And then that gives them time to figure out how they're going to deal with the loan with the other assets that exist that they're inheriting.
Sure.
If it's 1999 and you just happen to own $1 million home.
Right.
And you die and your children find out that we now owe the federal estate tax because this house that mom and dad bought is worth $1 million, that they can't go to the bank and get a loan.
Right.
In the same way the $100 million business owner estate can.
Right.
So life insurance became a simplified answer for individuals who didn't have quite the access to complex tools to deal with this.
Right.
And that has shifted immensely. And so the effort to convince people that they might have an estate tax liability is something that needs to have a little bit of a skeptical eye placed on it. Does not mean it doesn't work, doesn't mean that you shouldn't think about it. But there is a certain set of, what they're telling me versus what my reality is. One of the big ones would be, well, if the exemption is $15 million and my total net worth is 7, I think we got room to run here.
Right. Yep.
So I don't know that I need to go through all this. Now, there's 2 very important caveats to bring up that have nothing to do with the federal estate tax, but they talk about, or this is done in the context of life insurance for the sake of estate liquidity. One, we addressed last week, which is the fact that it doesn't matter how large your estate is. It's good to have money on hand when you die.
Sure.
Because probating an estate takes time and it costs money.
Right.
The other piece that is very specific, more so than we're going to have time to get into today, is the fact that there are some states that have their very own estate tax.
Yep. And
they have, in some cases, lower exemptions than the federal estate tax.
Right.
And in those situations, ILITs work too.
Yep. But there was something we were talking about beforehand. I wanted you to just briefly discuss, just to illustrate. There were with this coming up last year in the bill. I'm just going to call it the bill. There was a flurry of activity around setting up new ILITs. Mm-hmm. I don't know how many. I don't know how many were actually established. I just know there was a hubbub.
Yep.
And now some people are very clearly not subject, but they have the trust and they've gifted the money. And
yep.
My point being, it's not real easy to unwind.
No, it is not. And this creates a dilemma. It also creates an opportunity for advisors, lawyers in some cases, to now market the exit strategy.
Mm-hmm.
So, and it's taking off. Like, there are absolutely people out there looking for solutions to undo the ILIT that they established, because
it's not as easy as just saying, I just want to stop doing this.
Correct. And all the things that we covered, they have it. So they paid the money to have it created. They may be paying somebody trustee services to act as trustee. And they're also looking at the commitment that they've kind of sort of made in terms of the gifts that are having to be made to the ILIT each year to pay for the premium.
Right.
And going, well, I don't want to do this if I don't have an estate tax liability, and I don't likely have one.
Right.
So the problem, though, is that aspect that it is, in fact, irrevocable. So you don't get to just say, you know what, cancel that, give me my money back. That's not how that works. When you make the gift, it's no longer your money.
Right.
And the trustee does not have a fiduciary duty to you. They have a fiduciary duty to your beneficiaries.
Right.
Who are now technically, kind of, sort of, the owners of the money that you gifted to the ILIT.
Yeah.
So it's not as simple as, scratch that, let's just liquidate this thing and I'll take my money back. There are things that can be done. And again, part of the complexity of having an ILIT drafted is the skill of the attorney, and what, if any, provisions exist within the ILIT to kind of nullifies the wrong word, but I'm going to use it nonetheless. Under circumstances where it's decided the ILIT doesn't make sense.
Right.
So way oversimplification situation would be the ILIT is drafted with language that basically says, if the exemption changes to a point where we can reasonably argue that this is not economical because it doesn't serve any purpose, there is kind of an ability to undo the ILIT.
Right. There's one last point I want to bring up, and this has nothing to do with last year. This has been forever. This is the basic structure of ILITs, and a lot of people don't realize this. And I've seen some people have problems with this. If you buy like 99.9% of all ILITs I've ever seen were funded with cash value life insurance.
Yep.
Not funded, but they purchased cash value life insurance with the money that's gifted to the trust from the grantor. You don't own that cash anymore.
No, you do not.
The trust owns the cash. So you can't just willy-nilly start taking cash from the policy. I'm not saying you can't take cash from the policy, but it's not the same as owning it yourself, because you don't own it. The trust owns it, the policy.
Yep. There are special provisions.
You may be the insured, but you're not the owner.
Yep. There are special provisions that have to be added to ILITs.
Sure.
To potentially give you access to some of the cash in the ILIT.
And that's a whole process.
Yep, it is.
It's not just calling up the insurance company and saying, I want to take a loan for $50,000 from mine.
No. And you can't do it no matter what. It has to be done by the trustee.
Right.
So there are other ways to unwind these things, but there's kind of a process of essentially buying the policy back from the ILIT or swapping assets with the ILIT. Those run into some pretty complicated tax circumstances that have to be very carefully thought through.
Yeah.
So again, it's not an easy process to undo. And that's why we kind of harp on the skepticism about getting into ILITs when the justification for this, the estate tax, seems a bit dubious for your circumstances.
Right. It needs to be clear cut.
Mm-hmm. Because once you do it, undoing it is not easy.
Right. Exactly. Okay.
That's good enough for today.
Yeah, I think so.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.